Your bank earned $2,300 in interest on your money last year. It paid you $12. DeFi, decentralized finance, is the system being built to cut out that middleman entirely and give you the other $2,288. Here's what it is, how it works, and whether a regular person should touch it in 2026. DeFi is one of those words that sounds more complicated than it is. Let me explain it with an analogy you already understand. To truly understand the power of decentralized finance, or DeFi, let's start with a system we all know, a traditional bank. We'll call this the bank analogy. At its core, a bank is a financial intermediary. You deposit your savings, perhaps earning a modest 1% annual interest if you're lucky. The bank thanks you for your deposit, and then it puts your money to work. It lends that money out to other customers for mortgages, car loans, or business ventures, but at a much higher interest rate, say mighty mice, inken baisrawai, say imbai, inken komag, intoi mice, or selbonzer towai, info %. The 6% difference between what the bank pays you and what it earns from the borrower is called the spread. This spread is the bank's primary source of revenue. After covering its significant operational costs, like paying for impressive buildings, employee salaries, and extensive marketing campaigns, the remaining profit goes to the bank and its shareholders. You, the original owner of the capital, receive only a tiny fraction of the wealth your money helped generate. This model has worked for centuries, but it's inherently inefficient and opaque. You don't get to see where your money goes, and you have no say in the process. The middleman captures most of the value. Now, imagine we could replicate this entire lending and borrowing process, but without the bank. This is the fundamental promise of DeFi. Instead of a bank acting as the trusted intermediary, DeFi uses smart contracts. A smart contract is essentially a program, a set of self-executing code, that runs on a decentralized network called a blockchain. Think of it like a highly trustworthy digital vending machine. The rules of the transaction, like interest rates and repayment schedules, are written directly into the code. Once the contract is deployed on the blockchain, it runs automatically and exactly as programmed, without any human intervention or the possibility of tampering. It cannot be changed or stopped. This code now plays the role of the bank, but it does so with complete transparency and automation. So, let's revisit our example. In the world of DeFi, you would deposit your funds not into a bank account, but into a liquidity pool, governed by a smart contract. Another user can then borrow from that pool, again, facilitated by the smart contract. They pay the same 7% interest, but here's the revolutionary difference. There's no bank in the middle. There are no buildings to maintain or executive bonuses to pay. The smart contract is just a piece of code, and its operational cost is minuscule in comparison. Because of this radical efficiency, almost the entire 7% interest paid by the borrower is passed back to the people who provided the capital in the first place, the liquidity providers, like you. A small fee might be taken by the protocol to maintain itself, but the outcome is transformative. Instead of the 1% you'd get from a bank, you could now be earning closer to 6 or 7%. The interest, or yield, flows directly to you. This isn't a promise of future returns. It's the direct result of removing a costly and unnecessary intermediary. By replacing the institution with automated transparent code, DeFi ensures that the value generated by your capital is returned to its rightful owner, you. So, with all this complexity and risk, where would a newcomer even begin? To get an unbiased, data-driven answer, I decided to remove human emotion from the equation. I turned to an advanced AI with a simple but crucial prompt. The AI perspective on DeFi. I asked an AI to evaluate DeFi for a regular person in 2026. The goal was to identify the bedrock protocols, the ones that have survived market cycles, security threats, and the test of time. The AI's response was clear and logical, focusing on 3 pillars of the DeFi ecosystem. Its assessment, Uniswap for trading, Aave for lending, and Compound for earning interest. These aren't random picks, they are what the industry calls blue-chip protocols. But what does that actually mean? First, Uniswap. The AI flagged it as the go-to for trading because it's a decentralized exchange, or DEX, that has proven its legitimacy with billions of dollars in daily trading volume. Think of it as an automated currency exchange that never closes and isn't run by a company, but by code. Its longevity and constant upgrades show a commitment to security and efficiency. Next, Aave for lending. The AI highlighted its status as an established, time-tested money market. Here you can lend out your assets to earn interest or use your crypto as collateral to borrow other assets. The key reason for the AI's recommendation is its track record and security. Aav's smart contracts have undergone numerous professional audits, a critical stamp of approval in this space. The same logic applies to Compound, another pioneer in DeFi lending. Both Aave and Compound are trusted because they have high total value locked, or TVL. This is a core metric in DeFi that represents the total amount of assets users have deposited into the protocol. A high TVL, often in the billions, signals immense user trust and deep liquidity, making the platform more stable and reliable. These aren't fledgling projects, they are foundational pillars of the DeFi economy. These are the blue-chip DeFi protocols. They are considered the gold standard because they are transparent, have been battle-tested through volatile markets, are secured by extensive audits, and are trusted by millions of users who have locked billions of dollars within them. For a beginner in 2026, the AI suggests that sticking to these established names is the smartest way to minimize risk. But the AI's advice wasn't just about what to do, it was also about what to do. It issued a stern warning against any project, no matter how slick its marketing, that promises astronomical returns. The AI warns against anything promising 50% plus returns. Those are almost always scams or unsustainable models. It flagged unaudited contracts, anonymous teams, and overly complex mechanisms as giant red flags. In a world of decentralization, reputation is everything. The blue chips have earned theirs over years of reliable operation. New, unproven protocols offering unbelievable yields haven't. The AI's logic is simple. High returns always equal high risk, and in an unregulated space, that risk is often a 100% loss. So, after exploring the incredible potential of decentralized finance, we arrive at the most important question. Should a regular person use DeFi in 2026? Is it truly ready for you? And more importantly, are you ready for it? The AI's honest answer is a cautious one. Wait. Specifically, wait until you fully understand and are comfortable with the concept of self-custody, the practice of holding your own crypto keys. This isn't just a technical detail, it's a fundamental shift in how you interact with your money, and it's the single most important prerequisite for safely navigating the world of DeFi. In traditional finance, your bank holds your funds, they are the custodian, they have the keys to the vault, and you trust them to protect your assets. DeFi requires you to be your own bank, you are the sole custodian, you hold the keys. This grants you incredible freedom and control, but it also places all of the responsibility squarely on your shoulders. There is no safety net. Let's be crystal clear about what this means. If you lose your wallet password, or more critically, your secret recovery phrase, that string of 12 or 24 words, your money is gone forever. There is no customer service hotline to call. There is no branch manager to verify your identity. There is no recovery process. The very decentralization that prevents a company or government from seizing your assets also prevents them from helping you get them back. Your keys, your crypto. No keys, no crypto. It's that absolute. So, before you even think about interacting with a DeFi protocol, you need to be 100% confident in your ability to manage your own digital security. This includes understanding how to generate a seed phrase, how to store it securely offline, never on a computer or in a cloud drive, and ideally, investing in a hardware wallet for an extra layer of protection. But self-custody is just the first step. The second is a clear-eyed understanding of the other risks involved. We've touched on them, but they bear repeating. Smart contract bugs can be exploited, impermanent loss can eat into your returns and liquidity pools, and scams are unfortunately common in this emerging space. You need to be able to assess these risks for yourself. So what's the verdict? For absolute beginners, the recommendation is simple. Start with trusted centralized platforms. Exchanges like Coinbase or services like Nexo act as custodians for you. They manage the keys and the security, and crucially, they have customer support. If you forget your password, you can reset it. This environment is the perfect training ground. It allows you to get comfortable with buying, selling, and holding crypto assets without the immense pressure of being your own bank from day one. Think of it as learning to swim in a pool with a lifeguard on duty before you venture into the open ocean. You can graduate to DeFi when you're comfortable managing your own keys and have done your homework on the risks. Start small. Use test amounts you are fully prepared to lose. Get a feel for the mechanics of a transaction, the cost of gas fees, and the user experience of a decentralized application. Once you've mastered self-custody, accepted the risks, and familiarized yourself with the landscape on a centralized platform, then and only then should you consider moving a small portion of your portfolio into the exciting world of DeFi. I've put together a DeFi readiness checklist in the description, 5 things you should know before you touch any DeFi protocol. And subscribe. Next week I'm doing a walkthrough of Uniswap for complete beginners using AI as a guide.